Hello, in this presentation we will create an invoice within QuickBooks Online. It will be an invoice related to inventory. We will be selling inventory a guitar within the invoice. Here we will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. We are on the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem, entering an invoice and invoice for selling goods, selling inventory, in our case, selling a guitar. In order to do so, there's a couple of different ways we can get to the invoice. We could go to the drop down here where this plus item is. This has a lot of the quick functions and it's organized by customer, vendor, and employee. We would be dealing with customer and invoice. Once you start working with this a lot, this will probably be the most common way to go into the invoice. I'm going to go into the invoice, however, over here on the sales item tab. So sales, meaning we're going to make an invoice, which is would be reasonable to put in the sales grouping. And then up top, we're going to go into the invoices right here, selecting the invoices. And this is another way we can get to these invoices. And we will be creating a new invoice over here on the right-hand side, green button. Selecting the new invoice. We'll get a familiar type of invoice, and we're going to go through this form and just tab through it and enter the data. Note that as we go through these forms, we do want to think about what the journal entry will be. It's very easy to do these data inputs and not really understand what QuickBooks is doing. If we can understand what QuickBooks is doing, however, then we get a lot better idea of how to fix problems and what the financial statements are going to look like and how to read the financial statements and all that kind of stuff. So we note that if it's an invoice, that means that we're not receiving payment right now. Otherwise, we would use the form called a sales receipt. And therefore, the invoice really means that we're going to be increasing the accounts receivable. The account meaning making other people owe us, customers owe us within the accounts receivable account when that goes up. That's what an invoice will do for sure. The other side will be revenue. We're going to increase revenue. And that's going to be a sales item. In this case, sales revenue, because we're selling goods. If we're a service company, that's all there would be. If we sell goods and services, inventory, in our case guitars, then we're also going to have the decrease of inventory and the related cost of goods sold, all recorded by this simple form. When we put the data in, however, it's pretty easy to put the data in, and we don't need to know all that just to do the data input. If we want to know what's going on, however, we want to keep that in mind. So to put the data input, I'm going to put in the customer first. We select the drop down, we can find the customer. If we start typing in the customer name, which in our case is Anderson, we get the customer name, and I'm going to tab through. Now we're not going to have an email address, so I'm not going to put the email. If we're going to email the invoice, it's really helpful to do that. We can email directly from there, from this invoice, which is nice. Billing address. I am going to add a billing address because we are going to have sales tax. And the QuickBooks Online is going to need a billing address in order to calculate the sales tax. Now I'm going to use a California address because I'm more familiar with the sales tax there. So we set up the sales tax settings last time. If you want to, in a prior presentation, so you can go back and take a look in order to get that sales tax set up correctly. Once we have that, then I'm going to set up the address, and I'm just going to pick an address, which I believe is a pizza place here. And we'll have that, and that'll give us just the option. This is just a random address. And so that'll give us the calculation from the sales tax. We're going to say that the settings are going to be terms net 30. We then have the invoice date here. So the invoice date we are going to say is 01/12/21. So January 12th, 2021. That'll automatically give the due date then, which is February 11th, 2021. And I'm not gonna fill out the shipping information. I'm gonna keep that as is, and we're gonna just scroll down here then to the actual inventory items. I'm tabbing through everything to the product item. Now these are gonna be the inventory items we set up. So if we haven't set up the inventory items, you can go back and take a look at that. The setup process, we're gonna be selling goods in this case, meaning actual physical inventory. In our case, guitars. And we can select the drop down to see the guitars here and the other inventory items, and or we can start typing in our case it's a GTPR, that's the one right there. I'm going to click on that item, and it'll automatically populate based on that information that we put into the item list. So it'll give us the description. It's a Steinberger solid body. Quantity 1, rate is 410. It pulled that just from the items. Now note that that 410 is the sales price, the retail price. What is not being shown here is going to be the cost. However, QuickBooks is generating the cost. We'll talk a bit more about that as we go. We see that we do have the tax checked, so that should be correct, so meaning we're telling the system, hey, calculate the tax on this, and therefore it does, and we see this calculation. So we've got the 410 sales price. You can imagine that being, if we're in a store, that'd be like the sticker price on the guitar. That's what we actually sell it for. Sales tax, then, we have this 3178. Now that's going to be based on the calculation in terms of what state we're in and what the local sales tax settings are. Because this is kind of a generic problem, I want to make it so that it can be applicable to different states that have different sales tax. Note that once you know how to calculate sales tax, it's all the same. It's just going to be a tax rate times the sales. It's just the tax rate that will change. So I'm going to use a simple tax rate here. I'm going to just adjust this to a 5% across the board tax rate. So I'm going to just, for example purposes that could be more applicable just to the concept, 410 sales times 0.05, 5%, we're going to change that to $20.50. So we're going to say that this sales tax, we're going to say, is $20.50. And there we'll have that. It's going to say, do you want to keep that? Why did you do that? It doesn't line up to what we calculated. We're going to say, yeah, let's keep that. I'm going to tell it's an other, and it's an example problem, just to give them feedback to say they didn't mess up or anything. So you don't have to give them that feedback, but there you go. So there we have that. Now, and then we have the end here, the 410, the 20, and that'll give us the $430.50 is the total. So if we break all this down, what is actually happening here in terms of how is this going to affect the financial statements? We know that it's going to increase accounts receivable, meaning Anderson owes us money by the fact that it's an invoice. That invoice basically means accounts receivable is going to go up. It's going to go up by the full amount, the $430.50. We also know that sales is going to go up because it's an invoice, and sales is the other side that always goes up. And we can call it any kind of revenue account. In our case, we called it, I believe it's going to be in sales revenue. That's going to go up by the 410, however, not the 430. The difference between the two is the 2050 sales tax. That's going to be a liability account because we don't get to keep it. We have to pay it back into something like sales tax payable liability, not on the income statement, not affecting net income. Then we have two other accounts affected that aren't even on here in terms of dollar amount or account. One being inventories going down. We can see the inventory item here. However, the amount is the sales amount, not the cost. It's going to go down by the cost. We don't know what that is by this presentation. We'll see it when we look at the financial statements. We would see it if we looked at the items. And then the other side is going to be the cost of goods sold for this, which is an expense going up. So the income statement is going up by 410 and then down by the cost of goods sold, which we don't really know in terms of net income. So we'll take a look at that once we record this. Note, once we record it, we can save and send it if we had the email up here. Otherwise, we can save it. We can print it or review it if we want. Let's do that. We're going to say print and print or preview. And so here is our invoice. I'm going to go ahead and download that. And we're going to put that into this folder. So it looks like it's going where I would like it to go. So I'm just going to save that. We're going to say invoice Anderson. And I'm going to just put the date 01/12/21, something like that, and save that invoice, and there we have that. Okay, so now I'm going to go back and let's take a look at the financial statements and see what happened there. So this has been saved. We're going to X out of this, and then we'll go to the reports and see what this has done. So we'll go to the reports. And I want to take a look at all the reports. So let's take a look at the balance sheet, the main reports, the financial statements. We'll first take a look at that balance sheet. And we're going to change the dates from 01/01/21, the year that we are working in, 01/31/21. the first month of that year. And then we'll run that report and see what happens. So nothing happened to cash, of course. We didn't get cash. Something did happen, hopefully, to receivable, we would think. Let's click on receivable and see what we have in the detail. Within the detail, we see this accounts receivable. There's our invoice for 1004. If there's the 430, if we click on that, then we get back to our invoice here. There's the 430. That looks what's being affected. So we'll close this back out, see what else is going on. And we're going to scroll back up. We're going to go back to report summary. We'll scroll back down. So that was accounts receivable. The other side of the accounts receivable would be the sales side. So let's take a look at that second. That's going to be the accounts receivable went up. The other side's actually on the income statement. So let's go back to reports over here. We're going to go back to the reports. And QuickBooks calls that the profit and loss. So let's go look at the profit and loss report. So we'll type in profit and loss. And then we'll change the date range from 01/01/21 to 01/31/21 and run this report. We're going to get good at running these reports. And there we have it. And there's our sales item, the 410. If we click on that, that's our sales, the 410. If we click on that, there is our invoice. Note, however, that it didn't pick up the 430. It picked up the 410. So the difference, 2050, where's that going to be? Well, let's find it. We're going to close this out. That's going to be back on the balance sheet. So I'm going to go back to the reports over here. We're going to go to the balance sheet again. So balance sheet. We'll change the dates once again to 01/01/21 to 01/31/21. Run the report. And on the balance sheet, we then should have a liability, we would think, of sales tax payable. So here we have accounts payable. Here it is, California State Board of Equalization and other current liabilities. They didn't call it sales tax payable. They named the actual board we're going to sell to. Now, of course, this will differ based on the area we are at. So, and we might have multiple locations. So it's actually telling us a bit more detail than possibly we would expect, which would just be sales tax payable, that we owe sales tax. So that's good though, because it tells us exactly who we need to pay to right on the balance sheet. We're going to click on that. If we click on it, then we see our items here and our information and our invoice. So we're going to X back out of this or go back to the report. Now the other side of it is what we didn't really see on the invoice, and that's going to be the inventory going down. So that's going to be a balance sheet accounts. I'm scrolling all around the balance sheet. I'm looking for inventory. We're looking for inventory, so that's going to be up top under total accounts, other current assets, inventory. There's inventory. So we're going to click on that and see what happened to inventory. And we see that inventory is here. It went down by 328. I don't remember that number at all. And when I click on that number and go to this invoice, I don't see that number here at all. And it's not going to be here because it's on the items. When we created the items, that's when we set up the cost. So if I close this back out and we go to the sales and we go to the products services, we set up this ELP item here. And if we click on the edit, then we can scroll down and we see the sales price and the item for the ELP, which is not the inventory that we sold. So let's scroll back down. We're looking for the GT, this one. This one's the one we sold. So we're going to take a look at its information. And we'll see that we put it in their sales price 410 and the cost is 328. So the system knows the cost, but we're not going to put the cost on the invoice because we don't want to tell the customer what the cost is clearly. But the system will calculate it when we generate the invoice. Therefore, we'll see the invoice as the backup to the inventory going down, as well as the cost of goods sold. So let's see the last form. We're going to look at reports. We're going to go to the profit and loss again. Profit and loss, and we want to see from the dates 01/01/2/12/01/31/21 and run the report. And then we got the cost of goods sold. Here's the other side of that 328. If we click on that, we see this item once again. If we click on it, we have once again that invoice. Xing back out of that, going back to the profit and loss, we can see the effect on the income statement. Increase 410 from sales. Also an increase in the expense of cost of goods sold, 328. Net increase to net income then is only $82. Hello, in this presentation we will create an invoice with inventory into QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses, and a QuickBooks Pro desktop version course you can find at the link below. Here we are on the QuickBooks dashboard. We will be continuing with the Get Great Guitars problem. We entered an invoice prior to this presentation, and this will be the second invoice we will be entering with inventory. In order to enter an invoice, there's a couple places we can go. Last time we took a look at the inventory by going to the sales item here and then going to invoices up top and then finding the new invoice. This time let's go into the invoice by first going to this plus icon up top just to have something different. This will be the drop down customer, vendor, and employees, giving us the major type of data input forms that can be used in those categories. We of course will be in the customer category because we will be invoicing a customer, and we'll choose the invoice option. So we're going to have the invoice. Remember that an invoice is going to be used when we are not receiving payment at the same point in time. An invoice for QuickBooks in essence means we're going to increase accounts receivable, that account representing people owing us money. So we're going to increase accounts receivable, we're going to increase revenue, and we're also going to have, if we sell inventory, to decrease the amount of inventory and to record the cost of goods sold related to this. We'll talk more about that as we enter this and then look at what the effects of this invoice will be on the financial statements, balance sheet, and income statement. So we're just going to tab through this. Remember that the data input is really pretty basic for an invoice. That's the point of QuickBooks, having the data input to be pretty easy to do. It's a little bit more difficult really to think about what QuickBooks is doing in order to understand how the system's working. So we'll go through both here. We're going to go through the data input. We're going to start off with the customer. We select the drop down. We can see the customers here. If we type in the customer, it'll start to autofill. We're looking for Jones Guitar. There's Jones Guitar there. We're going to select Jones Guitar. And then we'll tab through this. So we're going to tab through. This is the email. I'm not going to enter an email. If you have the email, that would be great. And you can actually send directly with the email linked here. If not, then we'll print it and we can email it outside and or send it by mail or print it and give it to them in some other way. So then we're going to have the address. Now, note that the billing address over here is going to be really important once again because we want to calculate sales tax, and the new system with the auto sales tax calculation requires that we have either our address and or the billing address in such a way that we will be able to calculate the sales tax. If we don't have that, it's not going to be able to calculate the sales tax. So typically to create an invoice, you don't even need the billing address. But in order to generate that sales tax item, we do. I'm going to use just the same address for all of the invoices because I know it'll calculate how I want it to calculate just for an example. So it's going to be this address. Again, you need something there in order to have it calculate through what the sales tax should be. We're going to go through the terms then. Terms net 30. The invoice date. The invoice date is going to be 01/12/21. So net 30. Let's say net 30. I'm going to choose this one. And then the invoice date 01, and we're going to say 1/2/21. And then it'll give us the ending date 2/11/21, 30 days later. Then I'm not going to put any different thing into the shipping. We're going to go down to the product item then. These are going to be from the inventory items. So remember, we need to have the inventory items set up in order to be able to just populate this from the inventory items. We could do so by the drop down. These are going to be for us guitars. These are going to be types of guitars that we have on in the store. So we're going to type in GUS. That'll auto-populate. This is the one we want. There we go. It's selected. We have that. The description is going to be showing up automatically. If we scroll through the rest of this, we have one of these. The rate is going to be $380. The amount $380, and we do have sales tax. If we click off of here, then on some other line, it'll calculate the sales tax for us. Remember, if this doesn't populate there, the sales tax doesn't calculate, it's probably because, one, we haven't set up the sales tax, which means we have to add the state or that we have the sales tax in the sales tax preparation. And then we need to make sure that we have the proper address in our own address and the billing address to allow QuickBooks to calculate. Now, I'm also going to change this number because we're going to make it an even 5% just for an example problem. So all of our invoices is going to be an even 5%. And therefore, and remember, sales tax will be, as long as we know the percent, the calculation will be much the same. Meaning, we'll take the sales price, this is the sticker price on our case, the guitar, the inventory item, the guitar. And then we're going to just take 5% for the sales tax. So we're going to take 380 times 5% or 0.05, and that'll give us in this case, $19. So I'm going to change this item to $19, and that'll be the sales tax we will be using. QuickBooks is going to say, hey, you know, that doesn't look like the sales tax we calculated. We're going to say, yes, we want to keep it, and I'm just going to tell them it's a practice problem, and that's why we're doing it. So if we take a quick recap of what is happening here, then remember that we're going to look at the financial statements and see what is going to happen once we generate this invoice. We know that it is an invoice, and then therefore accounts receivable is going to go up. It's going to go up by the entire balance of $399, representing people owing us money. We know that revenue also is going to go up. However, revenue or sales revenue in this case, because we're selling inventory, it's only going to go up by the $380, the sticker price of the guitar. The difference, of course, is $19, the sales tax. That's going to increase not an income statement account, but a liability account, that being sales tax payable. Then we also have the fact that inventory is going down, and there's a cost of goods sold, an expense related to us selling that guitar. We didn't really earn $380. We earned $380 minus the cost of the guitar. We don't know the cost of the guitar. This is only the sales price, but the system knows it, and we'll see it when we go through and take a look at the financial statements. So we're going to go ahead and print this now. So we'll say print preview. We want to print or preview, and here is our item. We're going to go ahead and save this. So I'm going to print this item, or just download. Let's go up here. Let's download this item. And there it is, and we're going to say it's going to be an invoice. I'm going to give it the date first, which is 01/12/21, then we'll say it's an invoice for Jones Guitars, and we will save that and close that. Now let's take a look at the financials and see what happens to the financials. So we're going to close this out, Xing out of this item. We will then go to the reports on the left-hand side. We're going to bounce back and forth a bit between the balance sheet and income statements, starting with the balance sheet. So I'm going to type in balance sheet here. We're going to go to the balance sheet item and take a look at the balance sheet. We're going to put the date up here. It's going to be 01/01/21 to 01/31/21, and then run that report. So here we have it. Now we're going to go through here. The invoice means that it's going to be a receivable. So we know that receivables is going to be affected. So we'll select the receivables item. And we see the invoice here. So this is the Jones invoice. It has the $399. If we click on that, we can auto zoom down, and we see that invoice, the $399 being the total amount here. Now the other side of this, typically when we think about just recording a journal entry, I'm going to go back, I'm Xing out of that and going back to the report, is typically the sales or revenue account. That would be on the profit and loss statement. So let's take a look at that. We're going to go to reports over here, and we're going to select the profit and loss. So we'll type in profit and loss statement. Change the dates from 01/01/21 to 01/31/21, and Then we'll run the report. So for the month of January and the year we're working in, 2021, we have the sales of product income. That's going to be the sales items. That's the default. We're going to select that item, 790. And there we have our two invoices. This one was for Jones guitar, 380. If we select that item, then we have the 380. Note that's this amount, the sticker price, not the full amount, including sales tax. The difference of sales tax, $19. Where would that go? We don't get to keep that. It's a liability. So it's going to go on the balance sheet. So let's close that out. Go back to the balance sheet by going to Reports. We'll type in Balance Sheet. Once again, Balance Sheet in Reports. We'll change the dates once again. 01/01/2/12, 01/31/21. Note we can get quit pretty fast at that, but January 1st, 2021 to January 31st, 2021. We're going to run that report. And then we're going to scroll down. It should be in the liabilities section. And we have the liability of California State Board of Equalization. That's who we owe sales tax to. So rather than just having sales tax payable, like we may imagine, there we have this item here. There is the amount. So if we drill down on that, then we've got it broken down in a few different subcategories. But if we click on one of these items here and scroll down, we'll see the sales tax calculation. Now let's close out of this and let's go back. So we're going to go back to the summary report. And then we're going to look for the other items. So it's going to be a decrease in the inventory and the related cost of goods sold. The inventory, a balance sheet account, cost of goods sold, an income statement account. So we're going to go to the balance sheet and we're looking for inventory. Here is inventory. We're going to select this 2,264 in inventory. And we're looking for this invoice item here. So here it is for Jones. There's 304. So 304 is decreasing inventory from 2,896 by 304 to 2,592. If we select that item, then we see the invoice, but we don't see that amount. We don't see that amount at all. What happened there? Remember that we're not going to put the cost of the item on the invoice because we're not going to give that to the customer. However, when we generate the invoice, that's what triggers the cost of inventory to decrease the amount of inventory reported. So in order to find that, if we get the right guitar this time, it's a GUSA. If we close out here and we go to the sales and we go to product and services, and we scroll down and we find that if we want to check where that came from, it's right here. This is the sales price and this is the cost, $304. So that's where that number is coming from. It's going to be on the invoice or generated with the invoice, although it's not going to be actually on the physical invoice. So we're going to go back now to the reports one more time and we'll look at the profit and loss. Profit and loss. Going to the dates of 01/01/21 to 01/31/21, and we'll run that report. And then we got the cost of goods sold. That's going to be the other side. This is the expense related to us selling the guitar. So revenue went up, expenses went up. The difference is the effect on net income. If we select that item, then once again we see the Jones guitar, the amount of $304, which is the cost, not the sales price. Selecting that item, we get back to the invoice, and here once again is the invoice. Hello, in this presentation we will show how to create an invoice within QuickBooks Pro 2018, show the components of the invoice and what the impact of the invoice will be on the financial statements, the balance sheet, and the income statement. If you have been following along with us, that is great. We're going to continue on the Get Great Guitars problem. If not, that's okay because we will be going over the invoice. And if you want to learn how to create the invoice and what the impact of the invoice as well as the components of the invoices are, then that is what we will take a look at here. If you have access to the backup file up to this point in time, you can restore that by going to File and Open or Restore. And we, of course, would be looking for the restore process. and that way we can be exactly at the same point in time. We are entering data here, so at the end of this process, hopefully we're all in the same place in terms of the data. If not, we can do these restore processes as we go just to make sure that we can still move forward even if we made some kind of problems in the past. We will be working here with the creation of an invoice. We're currently at the home page. If you're not at the home page, you can go to the company and then home page at the top. Also recommend having the open windows open by going to view and then open windows so we can go back and forth between the windows that we will be having open as we move forward. When we create an invoice, we're looking at, in the home tabs, a component of the customer section. So note that we have the invoice within the customer section. We look through our nice flowchart, which we have in the home page of QuickBooks. We see the process then is to create an invoice. Then we're going to receive a payment on that invoice and then deposit it. If you think about the process that we have seen in financial accounting most of the time, they often will skip this middle step here, meaning we typically are going to create an invoice that will create a journal entry, or that will increase the receivable, people owing us money, and it will increase revenue. And then we typically just go right to putting it into cash when we think about journal entries in financial accounting. We have an interim step here, which will be to receive payments. The main goal of that interim step will be that we're going to try to compile all the deposits that we're going to deposit at one time into the bank together, and then deposit it into the bank so that the grouping of those deposits will match what is on the financial statements to what is in QuickBooks. So in any case, this will be the first step to our process. When we generate the invoice, this is the driving document that will help to show us who owes us money. It'll help to record the revenue as we create the invoice. The invoice will be created at the point in time that a purchase is going to be made. Note that the invoice is not typically used if we were to receive payment at the same point in time, meaning if we collected actual cash at the point of sale, we wouldn't want the invoice, we would want to create a sales receipt. Difference being that the invoice will record an entry to accounts receivable, meaning it'll show that the customer owes us money. We are using the invoice if we expect to be paid in the future, if we expect to receive a check in the mail at some point in the future for work that has been done today. If, on the other hand, we got paid today for work that got done today, we will choose a create sales receipt. That then will record the deposit or the cash at that point in time and the sale at that point in time. We here will be making sales with an invoice, meaning we're gonna do the work, and then we're gonna have an IOU, an accounts receivable, and then expect to receive payment at some future time to receive a check in the mail. So let's see what the invoice looks like. We're gonna click on invoice here, and we'll create the invoice. Now I have a summary tab over here. I'm gonna compress this so that we can see more of the screen. And here's the components of the invoice. Now there's a lot we can do within the customization of the invoice, meaning putting a logo on the invoice and this type of thing to make the invoice more ours in terms of presentation. We're not going to cover that at this point. What we're going to do at this point is just look at the components of the invoice and see the functionality of the invoice. What needs to be input on the invoice. Once we input, what's going to happen. What needs to be in place in order to be able to complete the invoice. At a later time, we can look at some of the details in terms of the formatting of the invoice, the look and the appearance of the invoice. So in order to create the invoice, of course, we're going to need a customer or job. Typically going to start off with a customer here. The template, that's going to be some of the formatting. So we have a default template at this time, the Intuit Service invoice. We need the date. We need an invoice number. This is another number that will be generated by QuickBooks typically as we create the invoice. The bill, the PO number if we have the purchase order, and we'll talk more about the purchase order at a later point, meaning if we are tying the invoice to a purchase order, then we would be tying this amount out And we'll talk more how to link that. We've created a purchase order in a prior presentation. It is possible to link a customer to a purchase order, that document used when we actually purchase something, in our case guitars, from a vendor for a specific customer. And then when we create the invoice for that specific customer, we can tie those two together or pull that information from the purchase order to the invoice. Then we're going to have the terms of payment here, followed by the item, the quantity, and description. Now when we get to the item, we're going to see where that's going to come from. We've taken a look at creating inventory items in the past, and that's where we're going to draw that from. It's possible to enter items as we go. It's also possible and highly recommended to have a list of items pre-set up so that when we set up the invoice, it's a nice, easy process, standardized process, one that we can do quickly, one that we can show someone else how to do without needing to know some of the stuff that we're going to go through here. So first we're going to need the name, the person, the customer that we are selling to. In this case, we're selling guitars. So we are going to sell a Stanberger solid body guitar here, and therefore we're going to sell it to Anderson, not therefore, and we are going to sell it to Anderson Guitars. So this, if I start typing this in, the name of the customer, it's going to appear automatically if we already have that customer set up. If I didn't know and I wanted to check, we could select the drop down, see our list of customers. Here's who we are selling to. I'm going to tab through this, and I highly recommend as you go through these forms to get used to tabbing through the form. It's a lot faster. So I'm going to tab, and then the date we're going to have of this transaction is going to be 01/12/21, and that'll be January 12th, 2021. We are working in the year 2021 for this entire process here, and so just keep in mind that's the current date that of our worksheet that we are working with. And we're going to keep it at invoice 1. This is the first invoice we are creating. The bill address, note we don't have one right now because we don't have one in our system for Anderson Guitars. If we were to mail the invoice, that would be a problem. Probably would be best to have an address if we have one. Not required, however, for the invoice to be generated, for the invoice to create the journal entry related to the invoice. PO number, we don't have one. That's the purchase order at this point, and we're not tying this to a purchase order. The terms, we're going to usually have like normal terms. We're going to say it's just going to be due in net 30. So it's due within 30 days. Then the item. So this gets down to actually what the guitar we're going to sell. Now, if we have all these set up like we should, this should be a nice, easy process. How do we have this set up? We've done it in a prior video, but what we do is we go to lists, and in the item lists, we should have all the items. So here's our inventory items over here. We're selecting from the inventory items. We are looking for that Steinberger solid body, and then here's the item number. So that will make it really easy to give someone else the authority to create these invoices and not be able to have to type everything in there. They already have it. If they start typing in the GTPR, that's our item number tab. It's going to format everything for us. We're only going to sell one of them in terms of quantity. The description should fill out, and then we should have the rate and the amount. So we have all that is going to be put in place at the same point, at the point in time that we create this. Note what is not here. What is not here is our cost. And so if we go back to the item list, notice I'm toggling through the open windows, and if you don't have the open windows, view open windows tab. If we go back to the item list, we can see that this solid body had a price here. If we edit it, go to items and then edit item, we see that the cost is $328. That's not shown on the invoice because clearly we don't want to give that to the customer, but it is going to be recorded. And this is what we have to understand when we create these invoices and when we generate them and when we record them in terms of what's going to happen to the financial statements. So if you're selling physical things, inventory, I'm going to go back here, going to go back to create invoices. We need to know that we're going to have the sales price, the sticker price on the guitar, but we're also going to have that behind the scenes cost that will be recorded. If, on the other hand, we are creating an invoice for a service like bookkeeping or something like that, then we're just going to have the sales price and that's it. We don't have any cost of goods sold. In this case, we're selling inventory in this particular example, and therefore we do have a cost of goods sold. We'll consider what that cost of goods sold is doing when we look at the financial statements. Note, we typically will have tax if we're in an area that has sales tax. That too is something that we set up in advance, putting in the type of tax, the amount of tax in accordance to the location, the state, and the locality that we are at. We used a 5% sales tax. Therefore, we're calculating another $20.50, and QuickBooks will then do that calculation for us, put it into a liability sales tax payable that we will then have to pay to the state at some point in the future. This then being the total amount that is due. What will this do when we select Save and Close? It's going to record a journal entry, and we'll take a look at it. It's going to debit the accounts receivable, meaning Anderson owes us money. It's going to credit the sales account. It's going to also debit cost of goods sold, and it's going to credit the merchandise inventory. So let's see if we can take a look at that, go to the financials and drill down on that. And even if we don't know debits and credits, we'll kind of get an idea of what's going up, what's going down, what's the effect on net income. Let's do that. We're going to say Save and Close. And you've charged Anderson terms for this transaction. This change will reflect. And we're going to say, yeah, go ahead and save that change. So next time we work with Anderson, it'll have same terms. Then I'm going to take a look at the reports. So I'm going to take a look at our main two reports, balance sheet, income statement, otherwise called profit and loss by QuickBooks, by going to the reports up top, selecting the drop down. We're going to go to company and financial. We're looking for the profit and loss. We're going to change the dates to the dates we are currently working in. Those dates being 01/01/212/31/21. Then we're also going to open the balance sheet. So we're going to go to the reports tab. We're going to go down to company and financial. We're going to scroll down within there to the balance sheet standard. We're going to change the date to the current date we are working in, ending at 12/31/21. Now, as we drill down on this data, we might want to have a date range here so that when we drill down, notice if I double click on cash, it only shows two date ranges when I'm of the same date when I'm trying to look at the activity. So if we want a date range here, I'm going to close this back out. Whenever we look into one of these accounts, drill down on it or auto zoom, then we could customize this report so we don't have to change the dates each time. So we'll go to Customize Report, and then I'm going to change the date, the beginning date, to 01/01/21, January 1st, 2021 to December 31st, 2021, and OK. Now we can see what is happening here. Now note, we made a sale to Anderson, so we would think accounts receivable would have a transaction. So we're going to double click on accounts receivable. There we have the accounts receivable increasing by that 430. If we double click on it, we see our invoice. So there's the invoice we've created there. I'm going to close this out. We know that the other side to accounts receivable on the income statement is sales. So that's our profit and loss, or our income statement. So I'm going to go back over here into our open windows. Sales is merchandise sales. If we double click on that, we see once again our Anderson guitars increasing sales. If we zoom on that, we're back to our invoice. So there's the 1/2 of our invoice, increasing the AR, the asset, increasing the invoice on sales on the income statement side, or the profit and loss side. So I'm going to close that. And then if we go back to the balance sheet, we also know that another thing happened because we sold inventory, that being that the inventory is going down. So here's the inventory. If we double click on that, we see that this inventory is going down by the 328, a number we did not see on the invoice. If we want to prove that, we can double click on it. There's the invoice. We don't see the 328 because, of course, it's not on the invoice, but QuickBooks knows that that's the cost. Gonna close this. That's what it's bringing down the inventory accounts by. The asset accounts going down by that. Gonna close this. The other side of the asset account going down is cost of goods sold. So I'm gonna go back to profit and loss. And we'll take a look at the other side in cost of goods sold. And we see that 328 right now, right there. And if we double click on that, there's the invoice once again. So there's 4 components that are really happening here. The invoice is a little bit more confusing than we might see on the initial post. And when we just create one, we can create invoices all day and not really understand the effect on the financial statements. And that's great because it helps us with data input and helps us to get other people to be able to create invoices without, knowing what the effect is on the financials. The effect on the income statement is revenue went up 410. Cost of goods sold, however, also went up 328. So our real revenue, our net income from this transaction, this being our only transaction for the time period so far in terms of the income statement or profit and loss, is net income of $82. One other report it's worth just taking a look at that is affected by this, and that would be if we know that the accounts receivable went up, and we could see that that went up by the 430, we also need to know who that is owed from. And we can go to Reports dropdown. We're going to go to Customer and Receivables, and we want the Customer Balance Detail Report. Looking at this report, we can see that Anderson owed us money before, and now they owe us another $430.50. Here's that receivable, also on the Customer Balance Detailed Report. And once again, we can drill down on that, and there's our invoice. Now we're going to close this up. We're going to do this one more time with one more customer. So I'm going to close this back out, and we're going to go back to the Home tab. And let's go back to the Home tab at the bottom, and let's repeat this process with one other customer here. So we're going to say that we're going to create an invoice. This time it's going to be for Jones guitar. We're going to sell a Gibson USA guitar. So it's going to be for Jones. And so if we type that in, it will then pull up if Jones is already a customer, as Jones is in this case. So there's Jones guitars. We're going to select tab. And we'll tab through this. We're going to have the template. We're going to say the date this time is going to be once again January 12th, 2021. Invoice number 2, and it's going to autofill. Bill, we don't have the bill to. Well, that would be the address of Jones Guitar, which we don't have at this point, and it would be nice to have, but not required in order to record the journal entry. We're going to keep it simple. Purchase order, don't have one at this point. We're not tying this particular invoice to a purchase order. We will do that, however, note in a future presentation. Terms, we're going to have the terms. I'm going to change the terms again to that net 30. So it's due within 30 days is what the terms mean. And then we're going to have the item is going to be the Gibson USA. Now the item number for that is GUS. And once we have that, then we're going to say tab, and it'll auto-populate everything else given the information that we have in our item lists, which we had prior put in accordance to the inventory items, including the sales price, as well as the cost of sale. We see the sales price here. We don't see the cost of sales, but the QuickBooks program knows it. So we're going to say that we have one there. Tapping through this, we have the sales price, and then we're going to calculate the sales tax on this. That's going to be the $19 for us. That will vary from state to state, from location to location. That gives us the $399. That then the check that we expect to see in the future. We're going to go ahead and save and close this. And I'm going to cancel this. It's probably best that we turn off the print later option. We're not going to be printing these at this time, but if you were to print it, you can go to the printing option here and print it as a PDF. We'll take a look at the printing and how we can do that. So we're going to go save and close, and yes. And then if we went back to our reports, just to check this out a bit more quickly this time, balance sheet, we're going to say that what happened in the receivable, same date range as we have here, should be in accounts receivable. We see that it has increased again by now the invoice for $399. Closing that out, we see that it should be in inventory assets, double clicking there, decreasing inventory assets, closing that out. Other side is on the profit and loss. We see that merchandise sales should be increasing, double clicking on that. There we see it here. And if we close that out, cost of goods sold being the other side, double clicking on that. And here's the cost of goods sold, closing that out. Now let's go ahead and go back and print that invoice just to give us an idea of the printed invoice and what that would look like. Back to the Home tab. I'm going to go to Create Invoice. I'm going to try to find that invoice again. A couple ways we could do it. We could go to the form and double click on it, or we could go to the invoice and hit the back arrow. And there we see the invoice again. We're going to go ahead now and print this invoice. Now note that when delivering the invoice, we could email it. We could send by email, we could print it out, we could mail it. Either way we want to do it. I'm going to go ahead and print it and take a look at what the actual invoice will look like. So if we print the invoice, now I'm not going to print it to a printer. I'm going to print it to a PDF file. So I'm basically saving it as a PDF file. A PDF is kind of like a digital printed document. So I have what's called a Qt PDF printer. That's going to be one type of printer. It's a free type of printer that can be used so that if there's no like save as PDF option, we can print to the printer. Notice we have a few options in terms of print on Intuit printable paper forms, black paper forms, letterhead. So you have a couple different options there. I'm going to go ahead and say print. And this process with this type of printer, the Qt PDF printer, it's a free download, would take a little while, and sometimes it requires us to point it where it's going to go to save it. So here we have it, and I'm going to put it on the desktop. I'm going to put it on desktop here, and see if I can find through all the stuff on the desktop where we want to put it. We're going to put it in Get Great Guitars on the desktop. I'm going to put it into section 7, and then I'm just going to change the name here to Jones Guitars Invoice, and then we'll put the date of the invoice, which is 01.12.21. Typically you want to put points or just have nothing in between. You can't really have dashes if you're using a Windows-based computer. If you're using a Mac, then you may be able to have dashes within the dates. So I'm going to save that, and we have that. Now I'm going to go ahead and go open that up and see what it looks like. So here is the invoice. So we've got our name, our address, we've got the date, we got the invoice. We don't have the bill to date because we had not filled that out. We don't have a PO number, purchase order, because we didn't have one. Terms, there's the terms that's due within 30 days. We got the one Gibson guitar rate amount, and then we've got the total down here, and of course the sales tax included in the total. So it gives you everything you need within just the basic format of the invoice is all you need. Obviously we could make it look a lot nicer by adding letterhead and our logo at the top and whatnot, and we can get into those types of things at a later time. At this point we're just getting down to the basics. This is what, if you wanted to just make an invoice, get it going, make sure that we're tracking what is happening, know what is happening within QuickBooks. That's what we're looking at here. And then we'll get into some of the features in terms of how to make the invoice look a bit nicer and add some of the features in terms of logos. There's a lot of options within QuickBooks to do some of that customization process, which is nice. Hello, in this presentation we will enter transactions related to the creation of an invoice into our bookkeeping problem within Excel, keeping in mind what that same transaction, the creation of an invoice, might look like in software such as QuickBooks. We're going to start off looking at what it would look like to input into software like QuickBooks, input an invoice for something like selling inventory, such as, in our case, a guitar. And then we'll jump over to Excel and see how that would be entered into our bookkeeping system within Excel. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. If we were to input this into something like QuickBooks, we would in essence just select the Create Invoice when we were trying to create an invoice for the creation or the completion of work. In this case, we are actually selling something. An invoice could be used if we were having a service company, if we did a service like bookkeeping services and we were billing the client, or if there's some kind of inventory. The difference between an invoice or what an invoice means, however, is that we have not yet received payment, typically. An invoice will mean we haven't got payment, meaning it's been shipped out, the work has been done, we earned the revenue, have not yet gotten the money, and expect to receive money in the future. If we enter an invoice into something like accounting software, it's typically going to have an input screen, something like this, and it'll be pretty easy to input the input screen if things have been set up the way they should be set up. And all we have to do is open up the invoice and put in the customer, in this case Anderson Guitars is who is purchasing, and then we're going to put in the date. The invoice number will typically auto-populate, and then we just need to choose the item that we are selling, in this case a guitar with this number. This is the item number of the guitar. We're selling one of those. Once we choose that, the rest will populate. The QuickBooks system, if this item has been set up correctly, will just draw out the fact that there is a Stanberger solid body guitar. The rate that we sell them for is $410. And the amount then is 410, which is 410 times 1. We do have sales tax on it at 5%, and the 410 times that 5% would be the $20.50, and that would give us the total then of the 410 plus the $20.50 sales tax that we expect to receive from the customer. That would all be done automatically. All we would have to know when inputting this information is who's the customer and what's the guitar number. The rest would then auto-populate. QuickBooks, however, is doing a lot more than just that when recording this journal entry. The person that puts this information into the system doesn't need to know much more than that. When we put this into Excel, however, we will need to know a little bit more than this in order to put this into the system in the format of a journal entry. So let's interpret this first. First we can say, well, the invoice itself means that we're dealing with accounts receivable. We're dealing with people owing us money, accounts receivable. People owe us money for work that has been completed, the work in this case being the giving of the guitar, and we have not yet received cash and therefore expect to receive money in the bank. Invoice often being something that we would mail out and receive payment at some future time. So we can imagine mailing it out with the guitar at this point. Then we know that the other side would be the sales side. Sales is increasing by $410. That's our sales price. So the receivable is increasing and sales is increasing. The receivables, however, are not increasing by the sales amount of $410, but by the sales amount plus what is owed to us for the sales tax, or $430. That $20 difference then is going to actually have to be going to a payable account because we owe it in the future. So we're going to have to include that in a payable account to the tax board that we owe, probably the state tax. And then there's going to be a separate part of this, and that's going to be the fact that we have to decrease our inventory, and we have to record the related cost of goods sold. That information not on the invoice. However, it is in QuickBooks if the invoice or the items have been set up correctly, and therefore we're going to have to put that same information in when we process this in the Excel format. So we're going to say that the cost is, in this case, $328, and we sold it for $410, and therefore we're going to have to record a decrease in the inventory of $328, and the other side, cost of goods sold, of $328. All that would be automated. We're going to see how that process would work in Excel as we enter the the journal entries related to this. So if we were going to do this same transaction with journal entries related to an invoice in Excel, that's what we'll do now. Here is our Excel worksheet so far. We've been entering data prior to this. The data has been hidden that we've entered journal entries in, so note we're starting on column F so that we can just limit the space we'll be working with. But that information is still populated over here in the general ledger and the creation of the trial balance. We're going to start here with the journal entry for this invoice that we are creating. The date of the invoice in cell F5 is 1/12. So 1/12, date of the invoice. So we are invoicing, remember, for work that was done, meaning we gave a guitar and we are earning revenue and have not yet received cash. That typically, first question I would ask, is cash affected? We're going to say no, we did the work, we gave the guitar, we're basically shipping the invoice out with it, and therefore cash is not affected. What is affected? Accounts receivable. We're getting a receivable and therefore need to put the receivable on the books. So we are owed money. The receivable is a debit balance account. We need to make it go up. So we're going to do the same thing to it, which in this case is another debit. So we will copy the receivable in AJ6, right-clicking and copying. Going to put that into G5, right-clicking and pasting 1, 2, 3. The amount then will be, we can do a quick calculation on this. We'll do it with the calculator first. We sell it for $410, but we're also going to have to collect on that the sales tax. So 410 times 0.05 for the sales tax would be $20.05 plus the 410 original amount. That'll give us $430. When we enter this into the Excel format, we're going to remove the pennies. We're going to round it just to make it look a little cleaner. So just be aware of that. If that's bothersome, note that rounding is going to be a problem no matter what. Even if we round 2 pennies, we'll have fractions that won't round out. So we're going to round to the whole dollars here, which would be 431. And then we can also calculate that, however, by saying if we have 410 times, we're going to get 100% of that plus another 5%, or 1.05, 105% if we move the decimal over 2 places. And we can say that is the same, 430. We'll do that same thing one more time in Excel. We're going to put our cursor here in H5 equals 410 times 1.05, 105% equals 431, or 430.50 cents. Note that we actually show the calculation here. So even though we can't see the decimals, if I go up to the Home tab and show the decimals, we know that, and I'm in the Home tab, Numbers group, and I'm just observing the fact that there are decimals there. We can make this a little bit larger, and just in case we had a bigger number there. So there we go. So I'm gonna go ahead and remove the decimals, however. Just note that if I multiply or do anything with this exact cell, Excel actually sees it as $430.50, even though it shows 431. So keep that in mind when you do calculations within Excel. So that's going to be the first starting point. Now, typically when we debit accounts receivable, we then credit what we have earned, or revenue. Revenue is typically the credit. We have 3 revenue accounts, and notice it's in order. We have the assets, liabilities, equity, and then revenue. Revenue down here, we have merchandising revenue or merchandising sales. That's our sales revenue account for selling our guitars. We have rent on music equipment, other type of revenue account, and service revenue for us when we're going to fix guitars and have guitar lessons, which is going to be exciting. But here we have a sale for the actual guitar, our first sale, so it's an exciting moment. And we're going to credit that amount. We already know we're going to credit it because we debited the receivable. If we think about it, we think that revenue is a credit balance account. It only goes up, meaning the customers don't pay us. We don't pay the customers. The customers only pay us, and therefore it only goes up. Now, you might be saying, well, there's going to be a problem. There might be issues that happen. When they do happen, there might be a return or something. We typically make another account called an allowance or returns. Or if there's other problems, it's typically an expense bringing down net income. But the revenue account generally only goes up, and it does so in the credit direction. So we're going to copy this account in AJ23, right-clicking and copy. Scrolling up and put that in G6, right click and paste 1, 2, 3. We are not going to credit for the 431, but for the sales price, which was only the 410. So the guitar actually costs, we're going to put a credit with a negative $410. And if we select equals, it'll put the brackets there. We can go ahead and indent this, home tab, alignment, and indent, or you can just hit the space bar 3 times, or you don't have to indent if you don't want to. And then we have the last piece. We're going to be off by the difference here, which is of course that $20.50, meaning this minus this, if I highlight those cells, will be calculated for us at the 21 here, rounded. And so we can then put that here. And of course, that is the calculation for the sales tax, which is the 410 times 5% or 0.05. So I'm going to go ahead and put that here. I'm going to use our plug formula, which is the negative SUM. I'm going to sum up with a negative, meaning I want to sum these, this whole, that, and that, from H5 colon I6, and then flip the sign. So we could just put in a negative 21 there if you want, or we can use that formula. I think that formula is useful. If we highlight the entire thing, then we're now at 0. We just need to know now what that account will be. We know that that 21 is sales tax that we collected, we're going to collect, that we now owe, and therefore we have a liability, something we owe in the future. We don't get to keep that money, and we owe the sales tax payable. Here's the account. We already know that we're going to credit it because that's what we need. And if we think about it, however, sales tax payable is a credit balance account as a liability, normal balance. It needs to go up. The bad thing's going up. We owe more money to the state, and therefore we're going to do the same thing to it as its normal balance or another credit. So we will copy this, scrolling back up, and put that in G7. Paste it 1, 2, 3. That's going to be our journal entry. I'm going to go to the Home tab. We're going to go to the alignment, increase the indent one more time. This is our journal entry. However, it's only half of our journal entry because the other half will be the decrease in inventory and the cost of goods sold. I'm going to post this first and think about this separately. I do want to point out, however, that when we do this manually in a system like this, it makes good sense for us to break this out into 2 separate components, recording it in 2 separate type transactions as if it were 2 separate transactions. However, it's not really 2 separate transactions. And if you're working in a computer system, you'd have to know that these transactions will most likely be combined because they happened at the same point in time and in essence are the same transaction, and the debits would be on top. So we'd have to be able to recognize that transaction in a computer system. So it's important to note that if we're making a complex transaction outside of a computer system and we want to make it in such a way that we can go back and look at it and figure it out, that's why we're breaking this out into 2 components, and we might break the rule of having debits on top and the credits on the bottom. If we're looking at a computer system which is driven by rules, meaning this happened at the same time and is in essence the same transactions and the debits always go on top, credits always go on bottom, then it's going to look a little bit different, might be a little bit different for us or more difficult for us to read. So keep that in mind as we do things outside, when we do things outside, when we do things in a computer system, why we're doing things in those different formats and how we can do so to get the best results. So let's go ahead and post this first. We're going to say, here's the accounts receivable. We're going to post that to the accounts receivable account, which is the second account on the trial balance and therefore the second account on the general ledger. I'm going to go ahead and freeze the panes first. So we'll put our cursor in AJ1. We're going to go to the View tab up top. We're going to go to the Windows group and select the Freeze Panes item and select the first item, which is Freeze Panes. Then we'll scroll over to the Accounts Receivable, and here it is. We're going to be on the second area in AQ9, and we want to point to that item, so we're just going to select equals and then point to this 431. Once we select enter, it will increase the receivable from 20,500 to 20,931. We're then going to do the posting for the merchandise sales. Here it is there. It's down here, way down here on the trial balance. Notice it's in order: assets, liabilities, equity, then income and expense accounts. It's our first income account, our first revenue account. Exciting moment in our problem. And it's going to be in the same order over here in the general ledger. So we're going to go to the right, just scrolling over with the right arrow to the right of the worksheet, finding the revenue account. It's going to be down here. There it is, merchandise revenue. We are always in the credit side. We're in cell currently BH22. This is cell BH22. Cannot quite see what we want up there. Gonna go over to the bottom here and make this it's at 120 right now %. Gonna zoom it down just a tad and see if we can zoom it down so that we can see these two things in one window. There it is. So we are in BH22. I'm going to say equals and point up to this cell in I6 and then enter. I'm going to go back over here and make this a bit larger again, back up to 120. If that was difficult to see, and if you have everything formatted exactly the way we do in the same cells, you can just type in equals I6 and that'll put that formula in there. We, of course, will see that 410 on the trial balance. I'm scrolling back to the left over here, back to the left. And there it is right there. There's the 410. Now we're going to post the sales tax payable. There's the sales tax payable. Here it is on the trial balance. We're going to go ahead and find that on the general ledger. Should be in the same order. So we're going to scroll over. There's the orange accounts or the liability accounts. Scrolling down to what looks like the sales tax payable in the credit column. So we are in the credit column. And once again, we can't quite see what we want there. So I'm going to go and make it from 120 down to 110. And let's make it a little bit. So now we're down to 100. So I'm going to put my cursor in BD25. I'm in BD25 equals, and then point to cell I7 and enter. I'm going to go back up to 120%. And once again, if that's difficult to see, we're in BD25. If I delete that, you could just type in equals I7 and enter. There's the 21. If we scroll back over, I'm using the left arrow, scrolling back over, and then going to this item, there's the 21 there. We should be back in balance, meaning the debits minus the credits equal 0. And we now have net income. We have income, meaning the credits of the revenue accounts are greater than the debits of the expenses, which we have none yet. And therefore, we have revenue of 410. That's a credit. Doesn't mean a loss in this case, in the case of our trial balance. That's the first part of our transaction. Now we're going to record the second part, the part not seen on an invoice, the part of decreasing the inventory and recording the cost or the expense related to it. We didn't really earn 410, or we did earn it, but our net income isn't 410. It will be less than that because we had to give up something. We had to give up an asset. We had to expend an asset, consume an asset, which was the guitar we sold. So we're going to reduce the receivable then. I'm going to do this in a separate journal entry, even though it's really part of the same transaction because it's easier to see that way. And therefore, we're going to go to the inventory. This needs to go down. We see here that we have a debit balance account and we need to do the opposite thing to it. So we're going to credit it. So I'm going to copy this. I'm going to skip a line and I'm going to put it on the bottom here. So I'm skipping a line to have a new journal entry. And then I'm going to put it on, there's the top of the journal entry. I'm going to put it on the bottom. So I'm over here in G10, right click, paste 1, 2, 3. Then I'm over here in I10 and we're going to put the amount, which was 328, which is going to be a credit, negative 328. Then we're going to debit something for 328. There's the debit to 328. We can indent this, go into the Home tab, go into the Alignment and Increase Indent. Then we just need this amount here. That's going to be the cost of goods sold. That's the expense of us using the inventory in order to help generate revenue. Most important expense for merchandisers called cost of goods sold. We already know that we're going to debit it because we credited the inventory. However, if we think about it, we know that it's an expense account. All expense accounts go up in the debit direction and they typically don't go down. Therefore, we're going to do the same thing to it and debit the expense account. So we will copy that, scrolling back up, and put that in cell G9, right click, paste, 1, 2, 3. Let's post this now. We got the cost of goods sold right under all the revenue accounts. So it's way down here. It's going to be in the same order: assets, liability, equity, income, and then expenses. This is a type of expense. So we're going to scroll way over here. We're using the right arrow once again, scrolling over, scrolling down. There's the cost of goods sold right there. It's going to be on the debit side. I'm in BK22, BK22. And we will say that that equals, and then point all the way over here to that 328. Once we select enter, it should populate to the 328. So BK22 equals H9. Scrolling back over, I'm scrolling all the way back over to the trial balance. We see we're out of balance by the 328. And we see that that 328 is here, and our net income went down. Meaning net income is the sales price, 410, minus the cost of the inventory we sold. Notice we can calculate that all nicely right here just on this little trial balance and see it all in this one little component rather than having a balance sheet and an income statement and a statement of equity. We can see it all right there if we understand the debits and credits. Now we're going to post the inventory side. Here's inventory, third account on the trial balance, third account on the general ledger. Scrolling over, scrolling down. Here's inventory, and we need a credit to inventory. So we are going to be on the right. So we're in AR 25, and we're trying to pick up that 328 equals that 328 will bring inventory down. So inventory went from here down by 328 to 2,569. If we scroll back over, we see that 2,569, and we are back in balance. Now that's going to be the first transaction, or the full transaction for the recording of that inventory. We want to do a few other things, however. First, we have a receivable. That receivable is recorded here, and we can see that people owe us $20,931. If I want to know more, however, including who owes us that money so we can try to collect on it, we can't go to the normal detailed account, the general ledger, and get that information. This only gives us the information by order of when it happened. We want to know who owes us the money, and therefore we're going to have to scroll all the way over to the subsidiary ledger, which will in essence put the same information in order by who owes us money by customer. So we're going to scroll to the right. We're going all the way to the right, all the way to the right. I'm just going to go to the subsidiary ledger we started in a prior presentation, and here it is. It's way over here in column CR, and we're going to say that Anderson is the one that is purchasing this guitar. So Anderson already owes us $5,000. Now we're in essence just going to increase that same amount. So I'm going to say equals and just post the same amount as we did to the general ledger here to the subsidiary ledger. And then it shows that Anderson now owes us $5,431. The total of all the receivables from all the customers is this, $20,931. And if we scroll back over then to the general ledger, we should see that same amount. So I'm scrolling all the way back over to the general ledger, and we're going to the accounts receivable account. $20,931 should be there. And we're going to go back over here. There's the $20,931 there. Then we have that information has been set up in terms of the receivable. We also note that we sold inventory. So we have inventory here, and we need to track the fact that we sold that inventory. So if we go back to our worksheet for inventory, note we have inventory on our trial balance there. But we need to know which inventory it is and say how many guitars we have and what's the value of those guitars. So if we scroll back over, we're going to scroll back over way over to our worksheets again. And we're scrolling back over to our worksheets. We've got our inventory worksheet, which looks like this. We have the inventory types here. And we're going to scroll down. We sold a GTP something type guitar. So that's going to be this item. This is the one we sold. We had one that was currently available to sell, and we then sold it. So we're going to go into the cost of goods sold section. So we are in J43, and we're going to say we sold one of those, and the sales price is just going to be that 328. And then if we multiply that out, we've got 1 times 328. That's the cost of goods sold that we figured out that we actually already put on our journal entry. This is how we could kind of work it up and back up that journal entry. And then how many units of those do we have left? 1 minus 1. I'm just going to say this is what we had. This is going to be on ending inventory now. So this is the cost of goods sold. This is what we recorded in cost of goods sold. We can see it here. And then we're going to record what's left in ending inventory. We have 0 now. We had 1 and we sold it at 328. You could just type in the 328. I'm using formulas. If we multiply this out, 0 times 328 means, of course, we have nothing left as of this date. So now we got to go down to this total down here. Notice what the total is doing. There's no best way to do this unless we use kind of a complex formula. If we double click on what this is calculating, we see that it's calculating the ending inventory on all these units here. So it's calculating the last unit. So here we have 1 unit at 400. We have 1 unit at 480. We have 1 unit at 440. And here we're picking up the 1 unit, and now we need to bring that cell down. So we're going to fix this formula as we go through this worksheet. We need to bring that cell down. This cell is CP 42, and we need it to be CP 43. So I want to bring that here. If I look at the formula, here's CP 42. I'd like to just bring that to CP 43. And there we have it. It has been adjusted. So we're going to go down, and so if I double click on that, it looks like it's picking up the correct numbers. If that's confusing, we could just go ahead and redo this formula as well. We could delete the whole thing and just say this equals, and I'm going to scroll up to the top of this item and just point to the items we want. I want that one plus, we want that one plus, we want this one plus, we want the last number in the column. So we want this one plus this one plus this one plus, that's the last one, delete that last plus, and there we have it. So we get the 2,568. That should match what now is on the trial balance. So I'm going to scroll all the way back over to the trial balance, holding down the left arrow, scrolling up to the top, and 2,569. It's a rounding error. So there's our amount in terms of guitars. It's off by $1 because of rounding. It's backed up by our subsidiary ledger. Now we can see what this looks like on the financial statements. We have our ending trial balance. If we were to tie this to the financials, we'd say that's going to the financials. We worked on that. We worked on the receivable. We worked on the inventory. That's going to go to the financials, and cost of goods sold. This would all be automated within an accounting system. If we scroll over to our financials, it's being generated from this information. There's going to be the accounts receivable. There's the assets. It's totaling up in our current assets. It's part of our total assets. And if we scroll over here, there's our owner's equity. And scrolling down, we now have income of 410. But we also have cost of goods sold of 328, giving us the gross profit of 82. No other expenses. Gross profit then at 82. And our equity down here is going to be totaled at 154.79, which is the beginning balance plus what was input by the owner investment. Then our net income being drawn from here. And that gives us our total change. And that gives us our ending balance in equity, that 154.79 being populated here, 150 as well. So that's going to be how this is going to be transaction. Notice that we put the journal entry in, and then we posted it all through this process. That can be automated by the accounting system. But if we understand what is going on, then we can go in and troubleshoot the problems within it. We will make the actual financial statements at a later time. Hello, in this presentation we will enter data related to an invoice into our bookkeeping problem within Excel, keeping in mind how that same information would be processed within a system, a computerized system such as QuickBooks. This is the second presentation, so we're going to go a bit faster in this presentation. If you would like more detail, then you can take a look at the prior presentation and get more explanation on how this process is working. First, we're going to start off with the QuickBooks entry and then go to Excel and enter that same data into Excel. If we were to enter the data into something like QuickBooks or any accounting software for the most part, we in essence could just do data input. We can select the create invoice, and supposing that everything has been set up as it should be, which is really the difficult part of the creation of the invoice, we just need to do some data input that's fairly simple to do, meaning we would need the name of the customer that we have, the date, the invoice number would populate automatically. We would have the invoice item. In this case, it's going to be the guitar. That would then populate the guitar of a Gibson USA guitar. And then that would populate the rate and the amount for that guitar. And then we would have the sales tax on that, which in this case is 19% or 380 times 5% sales tax is what we're having here. So we're saying we're selling it, sales price $380 times 0.05 gives us the $19 sales tax. And then we have the total that we're going to receive from the customer, hopefully in the mail, of $399. Remember, what this represents, however, is more complicated than just the data input. This is all we need to know in order to generate the input and send out the invoice. However, in order to record this and see what's going on the financial statements, QuickBooks is in essence saying, well, because it's an invoice, we're going to do something to accounts receivable and say that the people owe us $399. Because it's an invoice, we're also going to do something to sales. Sales is going to increase for this guitar, in this case, selling for $380. And then we're going to have to do something to the sales tax because we had to apply that. And we don't get to keep that $19 of the $399 we got. We're going to have to give it to the state. So we're going to have some kind of payable saying that we owe the state that $19 that we're going to receive from this sale. Then we also have the fact that we had inventory that we sold, and that amount is what we bought it for. We need the cost of the inventory in order to reduce the inventory. That cost not on the invoice. We're going to say it's $304, but note it's not on the invoice because clearly we're not going to tell the person who purchases it, most likely, what the cost is to us. But when we create the invoice, when we use this item, if set up correctly, then QuickBooks knows about it and can track the inventory on a perpetual system and record the fact that inventory is going back down and the related cost of goods sold is going up. So we're going to record that journal entry now into our Excel bookkeeping problem. Here we are back at our Excel bookkeeping problem. We're going to enter this journal entry as of 1/12 into this system. We had a similar journal entry up top. We're now entering another journal entry. It's going to be looking much like this with the new number for the new guitar we have, this being a Gibson USA, having a bit different sales number and cost of goods sold number. But in essence, we're saying that because it's an invoice, we didn't get cash because that wouldn't be the function of the invoice. That would be like a sales receipt. And what we have is an IOU, so you can think of us as mailing out the invoice with the guitar that we sent out to the customer. And we're going to increase that, and therefore we're going to do the same thing to it as its normal balance, which in this case is a debit. So we're going to copy this accounts receivable. Going to put that on top of our journal entry, right click and paste 1, 2, 3. The amount that was on the invoice is going to be the full amount, which will include the sales price and the, let's do the calculation for that. It's going to include the sales price and the sales tax. So our sales price was $380. Sales tax is 5% times 0.05. That's the 19 plus the original sales price of $380 gives us the $399. Or we can do that with one calculation, often very useful to know, which is 380 times 105%, 1.05, 100% plus an added 5% for the sales tax gives us the 399. We're going to do that calculation one more time here. Saying equals, and we're going to put the sales price of 380 times 1.05, and that'll give us that 399. You could just type in the 399 as well. Now, we're going to credit something. Typically, we credit the sales. That's going to be this item, merchandise sales. It's in order, assets, and then liabilities, and then equity, and then revenue. Merchandise sales always has a credit, and it always goes up in the credit direction. And we're going to do the same thing to it in this case, which is another credit. So we're going to copy this in AJ23, right click and copy. Going to put that into the cell G13, right click and paste 1, 2, 3. We will then indent. I'm going to go to the home tab, the alignments group, and indent. And the credit will be not for the 399, but just for the sales amount, which was the 380. So we're going to put a credit negative 380 and enter. Now we have debits here of 399 and credits of 380. That difference is that $19 for the sales tax. I'm going to put that in a calculation with the negative sum function. I could put just negative 19, but I'm going to use the sum function here. This is kind of the plug formula to get that last number in our journal entries. And we're going to say equals, or negative, SUM. And then double click the sum function, highlight from H12 to H13. And that'll take everything in there and sum them up. However, this being a negative number means it'll be 399 minus 380 and flip the sign to make it a negative. And that's what we want. So if I highlight the entire thing, then we can see that it sums up to 0. And that's what we want, meaning the debits minus the credits equal 0. That amount then is going to go to a payable. That's what we took from, that's what we're going to get on the sale, but we don't get to keep it. We have to pay it to the state, and that's going to be the sales tax payable. We already know that it is a credit because that's what we need in order to put our journal entry in balance. We can see here that we have a credit in the payable because it's a liability. It's going up. The bad thing's going up. We owe more money, and it does make sense then that we will credit this account. So we're going to copy the sales tax payable, put that here in G14 and right click and paste 1, 2, 3. Going to go to the home tab, the alignments group, and indent. There's going to be our journal entry. That's only the first half, however, of the journal entry. We still need to record the reduction in the inventory as well as the related cost of goods sold for the sale of that inventory. When we do these by hand, it's often useful for us to break this out one by one, meaning break out the sales half and then break out the inventory and cost of goods sold half. When you see this in a computer system, however, the computer system will most likely just follow the rules of this was all done at the same time, all part of the same process, debits go on top, credits go on the bottom, and we need to be able to recognize that within a computer system and be able to break it out in the way that would make it most easy to read when trying to explain the journal entries to somebody else in outside of the computer system. So just realize you'll see that in two different formats. So we're going to go ahead and post this. We have journalized the journal entry. We're going to then post that to the general ledger, and then that will populate the trial balance and create the financial statements. So here's going to be the accounts receivable. That's the second account on the trial balance, therefore the second account on the general ledger as well. I'm going to scroll up top and we're going to freeze the frames to make this a litting bit easier. Putting our cursor in AJ1, we're going to then go to the View tab, the Windows group, freeze panes, and freeze the panes. That means that when we scroll over here, it'll be frozen and we can see these at the same time, which is a big benefit. We're going to be down here in AQ10, so we are in AQ10. Going to select equals and just point to that 399. That should bring the receivable up from 20,931 to 21,330 right there. And we see that amount then too should also be here in the trial balance. Then we're going to have the sales merchandise. It's going to be in order: assets, liabilities, equity, and revenue. This is a revenue or income account. It's going to be in the same order as it is shown here on the trial balance in the general ledger. Therefore, we're just going to keep going right, just holding down the right arrow till we see those dark blue accounts, those accounts related to the income statement. Starting with the sales of merchandise sales. Here it is. I'm in cell BH23. BH23. We're going to say that equals, and then point to that $380. That's going to bring the credit balance up in the credit direction from 410 to 790. If I scroll back to the trial balance, I'm just holding down the left arrow here, scrolling back to the trial balance. We see that populate right here, 790. We see that we are out of balance by the sales tax, the last part that we have to post. We see that the revenue went up by the fact that it went up to 790. This being a credit in this calculation, not a negative number, not a loss, but revenue calculated as revenue minus expenses. We then have the sales tax payable. Here's the sales tax payable. This is a liability located here on the trial balance. We're going to find that same location over on the general ledger. So we're just going to go to the right till we see those orange accounts. We're scrolling right. We see the orange account. We're looking for the sales tax payable. There it is down here in the sales tax payable. We are in cell BD26. BD26. We want to get that 19 over to BD26. We're going to do that with an equals and then point to that 19. This is a credit. That's a credit. Those are the same things. When we do the same thing, we will increase the account balance from 21 to 40. So it's an increase. That's not a negative number in terms of debits and credits. It is in terms of Excel, but in terms of debits and credits, it's an increase in the credit direction to a $40 credit. We see that we are in balance down here. We're back in balance from that journal entry. So that's the first part of it. However, we also want to track this receivable not just by date of the receivable as it's tracked in the general ledger, but we also want to track it in terms of who owes us the money. If we were to do this by hand, we would have to actually do another subsidiary ledger. If we do this within accounting software, what will happen is the software will not let us post an invoice or some transaction like this, a journal entry, to accounts receivable without a customer. And then in order to do that, the system can then automatically apply this information in multiple ways. One, by the GL, how it happened in terms of date, and two, by who is owed. We here, working this in this system, will have to put this same information in our subsidiary ledger so we know who owes us money. This one came from Jones Guitar. So we're going to scroll to the right. We're going to go all the way to the right till we have put this information for the subsidiary ledger. It's way over here. We see these green items. It's way over here on the CR. So you'll see CR, accounts receivable subsidiary ledger. And the reason, by the way, we put this way over here rather than creating multiple tabs is just so you can see everything on the same page and we can hide things and put things side by side this way. So there is a reason for that. So there's pros and cons to setting up any format of these worksheets. But in any case, we have Jones here, already owes us $7,500, purchased another guitar, and now owes us another $399. So we're going to say that this equals the $399 and enter. And so now Jones owes us $7,899. The total balance is $21,330. That then should also be on the general ledger as well as on the trial balance, $21,330. Let's see if that's the case. Scrolling back over to the trial balance, I'm just holding down the left arrow. Scrolling all the way back to the trial balance, we see the receivable at $21,330. That looks good. Scrolling back, we see the trial balance here, $21,330. This was the general ledger. This is the trial balance. Okay, so we have that. Now what we want to do is record the other side, the inventory decreasing and the related cost of goods sold. We already gave the number, what the cost was when we looked at our worksheet, when we looked at our data. But if we were working this problem, we may have to do a cost flow assumption in order to do that. We'd have to track our inventory. So let's go over to our inventory worksheet and see what the cost of this item is. So we're going to scroll back over here. I'm going to go way back over here to our inventory worksheet. And that looks like this. And we had to track each piece of inventory in this format, meaning we had an ELP type of guitar, and then we had this type of guitar, and then we had these, and these of course are just the codes for the guitar. This type of guitar, and then we had this type of guitar, and then this is the one we sold, which happens to be the code for a Gibson USA guitar. And it looks like we have two of these currently available. They both cost $304. We're using an average method, by the way, which is the method that for costing inventory, which is the method that the desktop version of QuickBooks would use, but you can also use FIFO or LIFO or some form of specific identification. And so we're going to use the average method here. And we're going to say that we sold one. So in the cost of goods sold, we're going to say we sold one of these at the 304. And if we multiply that out, then we're going to say that we have one that we sold times 304. And that gives us the 304. That's going to be our cost of sale. Then we want to know how much we have left then. Well, we had two of them. Now we only have one at 304. I usually represent that with a formula by saying that equals the two that we had before minus the one that we sold. Means we have one left at the same 304. And that means that we have equal to 1 times 304, or 304 left on the balance sheet in the assets account. So then we need to go down here. If we look at our total, then what do we have in total inventory? If we total up all these guitars that we have, we got to figure out what will be left. This formula we're going to have to change because it's not a complex formula. It's just a basic formula. And every time we have a new row here, we need to go back in and adjust this to this new row. So if I scroll down through this, we've got this last number, the last number, the last number, the last number, and then here it's picking up the wrong number. So what we can do is we could adjust this formula. I can see that this is in CP 76, and I really want it to be picking up 77. So here is CP 76. So we could just delete that and say pick up 77, please. And then that should be correct. Other way we could do it is just to delete the whole thing and just say equals and pick up the ones we want. I want that one for this particular guitar, plus we want that one for this particular guitar, plus we want that one, plus the 0, the second one, plus this one, plus this one, and enter. So we could have a more sophisticated worksheet than this, obviously, to have a formula to figure that out. But this will work for us and have a nice simple formula so that we can work just with plus and minus type of formulas. So there is that. And once we enter the journal entry, then we will end up with what's left in inventory, hopefully, of that 2,264. And this worksheet then will back up what is in the inventory amount. So I'm going to scroll back up. And we're going to then record this journal entry for the 304. So let's go all the way to the right again. I'm holding down the left arrow, going all the way back to our worksheet over here. And we want to record the second side of this. And we said that the inventory is going to go down. So I always start with that because it's an asset. It's easier for me to know which way that's going. It's like checking account. It's going down. So we're going to do the opposite thing to it, which in this case is a credit. So I'm going to copy the inventory. I'm going to skip a line to make a new journal entry. I'm going to skip another line because I want this on the bottom of the new journal entry. And I'm going to put it down here in G17. Right click and paste 1, 2, 3. And then we can go to the Home tab. We can go to the Alignment group and Indent. And then we're going to be down here in I-17. The amount's going to be a negative 304. That's the cost of the inventory. We're going to debit something for 304. When we gave up that inventory in order to help generate revenue, we have an expense. That expense, our most important expense for merchandising, that called cost of goods sold. Cost of goods sold is an expense, has a debit balance, only goes up in the debit direction pretty much, as all expenses do. There are exceptions, but it always goes up in the debit direction for the most part. And then we're going to copy that. We're going to put that in the cost of goods sold section, right-clicking, pasting 1, 2, 3. We will then post this out, first cost of goods sold, it being way down here on the trial balance and therefore also way down there in terms of the general ledger. So we're going to scroll back over here till we see those dark blue accounts, those income statement accounts, and then look for the cost of goods sold account. I see it there. We're in the debit side of it in cell BK23. We are in BK23 and we're going to select our equals and then select the 304. That will bring this expense account up to 632. Scrolling back to the trial balance, scrolling down to our data, we see that we're out of balance by the 304 till we record the other side, and net income has now gone down by that, meaning we increased the revenue with the first one and then the expense, the cost of goods sold, and of course what we really got net is recorded here. Then we have the other side, the inventory asset. That's going to be the third account. So we're going to find the third account. So we're going to scroll back over here. Inventory asset is going to be the third account, which I believe is down here. And it went down, so we're in cell AR26. AR26. And we're going to pull over that 304. So we're going to say that equals and point to that 304. That's going to take this 2,569 down because we're doing the opposite thing to it, to 2,265, which hopefully sounds familiar because it should match what's on our inventory ledger. And if we scroll back over here, then we are now back in balance. We see this same amount in the inventory, 2,265. And if we go back to the ledger, 2,265, I'm going to scroll all the way back to our inventory ledger. I'm just holding down the right arrow just to double check. If we scroll down here and we get to the 2,264, it's off by rounding because of $1, so that's okay. And we're going to say that those two match out. So this is backing up then what is in the account for that's on our financial statements for inventory. Scrolling back over all the way to the left, we are back to our accounts here. We can see how the financial statements are then created. Looking at each of these amounts, we're going to look at the inventory. We just made some adjustments there. We made some adjustments to the accounts receivable, and we made some adjustments to cost of goods sold. We are going to go to the View tab before we go over there and go to the Windows, and I'm going to unfreeze the panes. We're going to unfreeze the panes. And then we can scroll back over here and we can see what is going on. We see that the receivables is here and it's being generated, and we can see that our total assets equal our total liabilities and equity. And this is just to show that this is just being automated. And once we enter the journal entry and create the trial balance, we can in essence automate the system, and this is how it's being automated in essence with accounting software. So we just need to know how this is being built, and we can go through this. We will go through this later and build these financial statements to see how that automation process can work and why some processes can be automated while other processes need to be not automated. We have to actually do something there. So then we have the sales here is going to be sales, and the cost of goods sold gives us the gross profit. We have no other expense accounts at this time. Therefore, the net income is the 158. We have the stockholders' equity. This was the beginning balance. When we entered our beginning balances, the investor, the owner, put in the 65,000. We have the 158 net income, and that gives us a net increase to the 150,555, which then matches this amount here.